Hello, welcome back. Here is a very interesting stock to talk about, and this has been in our discussion on our Discord channel today because it has plunged. It's actually down on pre-market today. The market is about to open in about 30 minutes from now as I'm making this video. Upstart plunged again after admitting it won't hit disappointing forecast. So they fell more than 56% after issuing short guidance in May, if you remember that. We have made a video about this when that happened back a couple of months ago, and declined about 19% today. That's pre-market Friday, disclosing that it will come up well short of that target. And so the stock has been completely devastated and has lost a lot of its value. And as I've made a video about it, again, about a couple of months ago, it used to be about $75, $77 or something of that sort. And back then it wasn't really a buy, but since then it's coming down a long way. It's right now it's going to open at about 27 bucks. And now this presents an interesting opportunity potentially, and this is why I wanted to make a video, a very interesting stock to talk about, and company really to talk about, because it has fallen off a cliff. Take a look at this one. It's down almost 92% from its one-year high. It's outrageous one-year high of $400, where it was extremely expensive. Now, if you don't know about this company, you may know that it's a lending platform, and you may be thinking that it handles credit, but it's not really working this way. For the most part, it's about a cloud-based artificial intelligence system. It's a lending platform that's trying to connect borrowers and lenders here. And so it doesn't actually get affected by debt so much as it's getting affected by the current environment in terms of lending and borrowing. And as you can understand, when inflation is raging, then interest rates are going to go higher. And when interest rates are going to go higher, then the cost of lending money becomes more expensive. So it's more expensive to borrow. And this means that the company will probably face some important headwinds. This is why I would love to be entering this kind of company at a very cheap valuation, as long as they are solvent, as long as they are not going to be having much trouble serving any potential debt that they have. And even though they don't really get affected by default claims from, for potential lenders, borrowers really, they still get affected by activity. And so if that goes down, their business could go down as well. Now, they have actually announced buybacks, but overall they have been issuing shares like maniacs, as you'll see here. They have announced about 800 million in terms of buybacks, and again, this is something that we have been discussing in our Discord with our great members over there. It's great for me because I'm getting some nice information, and I can present that to you. And the company is a $2.8 billion market cap company, so 800 million in terms of a buyback is a lot of money. It's about 30%, which is absolutely awesome. So if that happens, this is gonna really affect their outstanding shares count, and it's gonna make it better. There's gonna be less of those. Now, the company has been achieving great growth here. You can see it in net income, free cash flow, revenue, total equity. Everything has been growing upwards, which is nice to see. And the total liabilities, when compared to the free cash flow, they are not too much here, too many. So it's not extravagant, this number. 6.6 is okay. I mean, something less than 5 is even better, but 6.6 is definitely something that I could work with. And a P ratio of 18 and a price to free cash flow ratio also 18, which is like another good sign, because it looks like our earnings convert to free cash flow at about the same rate, which is a good thing to see. Yet you can take a look at the 5-year growth here. This has been a growth story that plummeted. And again, this is could potentially be a very interesting purchase as it's going down and down in terms of its pre-market price. And we'll see what's going to be when the market opens today in about a few minutes. Now, the margin that the company makes is about 15%. The return on equity is 20%, which is pretty fair here, pretty nice. And what I kind of want to take a little bit of a look at is the financial statements, just to get a sense of what the company has been doing. A very early IPO, a very recent IPO really. 55 million to 840. Amazing growth here. Now, remember, this is a lending platform, so if the activity of the economy goes down, then you could have less of activity, less loans. So this can be another tricky thing to navigate right now. what I would want to get out of this company is get it for extremely cheap if possible. Maybe even at a time where the economy is actually getting a little bit better. So this, I think, would be a prime opportunity to buy as interest rates would start falling again, actually. So when we're reaching a peak, which I think will actually deter this company from growing, it will actually bring it down even more, then it could be an interesting opportunity to buy again. As interest rates are going to go lower, then lending will start heating up again. And so this is when the company is likely to go to grow much higher and much more precipitously. And I'm very inclined to wait here for a very great opportunity, really, that will grow over the years. Again, it may take a couple of years, really. It may take a year and a half, maybe something of that sort. But I really feel that the price of the stock will go down even more from its 27, which is going to be what it's going to open up with. Probably, I think that's going to be the case for a while. Now, you will see that the net income of the company has been growing as well. So the company has been growing overall very nicely. Their balance sheet is something that you can see that their total liabilities here have been about 1 billion. And total equity, again, close to 1 billion. Now, 1 billion in terms of total liabilities, and if you take a look at the cash flow that the company generates here, you will see that it is positive, which is always a great thing, and it's about 6 times what we examined a little bit earlier. If you multiply that by 6.6, you get 1 billion, which is the total liabilities pretty much. And it's fair. It's totally fair. They do have quite some cash here, 1.2 in terms of billions of cash. And it looks like the company is in an okay position to actually fight off any potential problems. They may go maybe even negative in terms of what they're going to be doing in net income and free cash flow, but they don't seem like they're going to be losing too much money. They could have some negative years, sure, or they could have some low growth years, no doubt. But at 1 billion of cash, they're probably going to be just fine for the next 2 or 3 years. Now, I do want to take a look at our stock evaluation tool and go I will actually go very conservative here. The company has been enjoying great growth, lending platform that is very new, again, connecting lenders and borrowers. It's been doing great in terms of how they're growing, yet I'm gonna go very low. I'm gonna go, let's just say 8, 10 and 12 here, which more than likely super low here, but I wanna see what I'm getting out of this one, because as I said, I want to buy it at a very cheap price. This is my target for this one, that's my goal for this one. The net income margin has been growing and has been into positive territory from years of negativity. This is a good picture to see. You want this kind of progress for a new company. And it's getting to a 15% level right now. I'm gonna go 12, 13 and maybe 15 here. And the free cash flow margin, which again gets to territory that I would like to see here, about 100%. I'm gonna go 90, 100 and 110. I think makes total sense here. And 13% is what I typically like to use. Now I could go 15% here. We can try that, because this is a little bit of a riskier proposition. It's not your typical company that is much less risky. This one is a little bit riskier. Now, if I click calculate, because it handles debt, it doesn't actually provide debt credit really, but it handles debt, and so this is important. It's actually really affected by the debt market. Now, I'm getting a low of 20, and this is what I would actually want to go with. 20 would be probably my sweet spot for this one, if not less than 20. And if I go 15% on this 20 case over here, you will see that I'm asking for a 17.4 in terms of a return. Let me actually do this with 15 as well. I think this would be my metrics here, frankly. This is what I would like to see overall for this company. And at a price point of 17 or 15 maybe even, this would be a fantastic. Anything below 20 really, I think I would actually add to my portfolio this one. Again, a little bit of a riskier one for sure, and you may want to wait it out a little bit, play it out, see how that works during the high interest rate period. You probably don't want to be buying this one as interest rates rise. You probably want to buy that when they stagnate and they start falling again. This is probably the best time to be buying this one. So I would urge for some patience here. I would definitely be patient on this one. Just wait it out a little bit. I think this can be a multi-bagger really. It may take maybe a few years, 7, 8 years, who knows. But it could be a very great multi-bagger. And so if this goes below 20, I think I will be adding this one to my portfolio. So thank you for watching this. Tell me what you think about Upstart, and leave a comment below, and please like the video if it helped you a little bit. Thanks for watching. I'll see you soon. Bye bye.